Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you 1035 exchange life insurance to an annuity, and what exactly is this? How somebody would try to set up the cash value to therefore leverage it for maybe their retirement goal or some sort of income goal, and how to use an annuity to do so. Now, just as a little disclaimer in the beginning, you want to be very, very careful on how you do this because, sometimes it makes perfect sense to do it. Other times, not so much. But it's mainly meant for somebody that's looking for either a consistent growth goal or a max lifetime income goal, and then you want to make sure that it's customized specifically to an annuity that might work best for your benefit. Now, with cash value, what they mean by the 1035 exchange for life insurance, meaning that with any sort of permanent life insurance policy, what happens is an individual will place premium dollars into a plan. So kind of think of this egg shape as a plan. And those premium dollars, first and foremost, have to make sure that it's correlating specifically to a death benefit. Hence, life insurance all has a death benefit. So when premium dollars go into this plan, you have a portion of those monies go into something known as a cost of insurance and different expenses that relate to that death benefit. And then whatever you paid in addition to those expenses go into a secondary bucket known as cash value. So you have different types of permanent life insurance policies out there. You have whole life insurance, you have universal life insurance, you have variable universal life insurance, and you have index universal life insurance. And those are going to be the four major types of permanent life insurance coverage. Now, what happens is each time that you're placing more and more dollars into this plan and you're accentuating what those expenses are, well, it's going to go into that savings account aspect known as that cash value. So that cash value is going to grow each and every year that you're placing more dollars into that plan than what is necessary for that death benefit. And then on top of it, there's going to be a type of interest credit that's related to that bucket. So if you're placing more and more dollars each year, then that should grow the bucket. And then obviously if you're receiving an interest credit to that bucket, well, then that should also increase that bucket, further and further. So as we look at these four major types of insurance that's tied to that cash value, those types of plans, what happens is the interest credit off of a whole life insurance plan is set up through something known as a dividend rate. So this is more of like a fixed type rate. And universal life goes into interest rates. So this was something that was very attractive in the 1980s and 1990s when interest rates were very high. Well, since that point, interest rates have fallen down, deep below historical lows or below historical averages. So therefore, the universal lives have not been as attractive in more recent years. You have variable universal life, which is tied to mutual funds, meaning that this percentage rate could either be positive or it could be negative. If it comes back negative, well, then that entire cash value is susceptible to that downward market loss and to those fees that are also coming out of those specific types of accounts. And then the very last one is something known as an IUL plan, which became more and more attractive in more recent years. And what it says is it's either going to give you a positive credit if that specific stock market index that you chose goes up, and a 0% credit if that index goes down. So if we understand how this concept works with cash value, you have individuals that might have old policies. One of the examples is my parents. My parents got set up in the 1980s with a universal life plan, and the life insurance agent that, I'm not even going to call him an advisor, the life insurance agent that set them up with this type of plan told them to minimally fund this policy because cash value is correlated to interest rates, and interest rates will never go down. Well, unfortunately, a couple of years ago, they realized that their cash value was still sitting at a decent number, but their cost of insurance kept increasing year by year, and therefore was siphoning away from their cash value. So what happens is individuals that have old universal life plans, or they have whole life insurance plans, or variable or index universal life, not so much with the index because it's more of a newer blended product, but mainly those top three, if they're starting to see some good growth or they had some growth into their cash value, now they have this type of savings account component that's sitting into their account known as cash value. There's certain ways, there's certain beneficial ways on how that person could take out those dollars in a tax-free manner, or leverage it to roll over or transfer exchange into a type of specifically designed annuity contract. So I'm going to clear off the screen. So the individual that's probably watching this video says, yeah, I have an old life insurance policy and this thing has cash value in it. What exactly can I do with this cash value? Well, depending upon what your goal is, that's going to be the most important aspect. There's ways on how you could leverage this cash value and you roll it over into a type of non-qualified annuity that has specific either safe, consistent growth benefits to that account, or something that could trigger a lifetime income benefit to that account as well. So you might have somebody that was placing dollars into this plan. Let's say they were in their 30s and they were placing monies into a whole life insurance contract, and now this person's in their 50s or in their 60s, and they now have a large lump sum. Let's say this person has $300,000 that's sitting into their cash value right now. Well, they could either, depending upon which the company is and the carrier that they might have certain provisions that allow them to pull this out in the form of loans or take it out in the form of tax-free income. But be very, very careful when you're doing it, because each company is going to have their own nuance on how to pull out that money properly. Many times, and especially if this policy is older than 10 years, typically it's not going to be that favorable to pull out this money of cash value. So the only alternative, or the alternative to make sure that you're accomplishing your goals successfully, is to roll over those dollars into a specifically designed annuity contract. What this does is when you do the rollover, when you do the exchange, it's now going to take the $300,000 in this example, and it's going to attach this now onto like a $300,000 cash account that's essentially sitting there with certain benefits, such as I want to retire, next year, so I have it in this annuity. It's going to fester, it's going to defer growth within 1 year, and then provide me and my spouse lifetime income. So maybe this person has retirement accounts that they're trying to pull income out for retirement. They have Social Security that they're receiving for retirement. They might have a pension plan that they're receiving for retirement, and they might have a supplemental gap, or they might have a gap of, let's say, $10,000 that they need to take income from. So because they had this cash value life insurance, rather than play this guessing game and kind of take out $10,000 per year and run that risk of outliving their money, they could have that certainty and roll it over into a specifically designed annuity contract that correlates to exactly what their age is, what their sex is, and what their goal is, to provide that max lifetime income. Many times, if the person has 300,000, sitting into that account, many times you don't have to leverage the full amount. You just have to leverage what the smallest dollars are to correlate exactly to what that income goal. So that's why I say consistent growth and max lifetime income customized. And that means that you just want to make sure with the annuity product that you're going into that it's going to make sense, that it's not something that is just, a highly marketed annuity product, and it's not going to be the best possible leverage that you could do based upon your age, based upon your state, based upon the dollar amount that's sitting in the cash value plan. One of the other things I say is consistent growth, is because if your fees each and every year you're going to have a cost of insurance that is typically tied with these types of plans, meaning that your cost of insurance is going to be increasing, increasing, increasing. Well, if you want to preserve this cash value and leverage it for some sort of retirement play, retirement income play, well, then there might not be a reason to leave that money in that cash value. You could get a secondary death benefit plan, or maybe you don't need that death benefit anymore. So now you're trying to pull this cash value and really leverage it specifically, for your benefit. So there's ways on how you could do that. But rather than take all that money out and just throw it into your checking account, you could get taxed on that money, anything that you gained in addition to what you placed your dollars into it. So anything above your principal, if someone put in $100,000 into this permanent policy, they have $300,000 of cash value. If they try to take a full withdrawal of $300,000, well, then they could get hit with what that difference is with taxation. When you do a 1035 exchange, what it does is it goes from a non-qualified account to a non-qualified account, and it's a specifically designed annuity contract, and it goes off of something known as an exclusion ratio, with how each and every time you're receiving income, a portion of it is going to be principal, a portion of it is going to be a gain, and that's how, essentially how the taxation works. And understand, we're not tax advisors, so please, make sure to go to a tax advisor to get further advice on that. But what we do, and let me clear off the screen, we help you leverage what the best possible options are available to you. So based upon what your current circumstance is, based upon what your goals are, we go, and we're an independent agency, meaning that we're not going to be biased towards one company over the next. If there's a certain company that's going to be the best fit for you, we're going to tell you, listen, based upon your area, based upon all these different options that we've scaled through, and we utilize something known as the Retire Sharp planning system that allows us to go through over 1,200 different scenarios, products, and strategies on average per individual that calls in before we give our top 3 recommendations. So if you're looking to leverage an annuity contract for the 1035 exchange, well, then you want to make sure that you're using the smallest amount of dollars into the best amount of leverage, or the most amount of dollars into the best amount of leverage that is possible, based upon your age, based upon your goals. So that's one of the major things, and kind of the takeaways. You want to make sure that something's customized. And these companies, they're going to be fighting for your business. Some of them have niche criteria. For somebody that's 50 years old or 52 years old might be the best with company ABC, but then somebody that is 62 years old or 65 years old, the best company might be XYZ. So It all depends upon what your circumstance is. What I'm trying to explain to you guys with all the videos is you guys control the chips. It's your dollars. How can you place the dollars into the best leverage to make sure that you're getting the maximized result? And we are A plus rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. Is because the way that we conduct this methodical process, making sure that education is first and foremost, and really seeing what your different options are, and how to make sure that you're comfortable with with executing those options. So at any point in time you found value in this, feel free to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service, meaning that it could be mornings, nights, weekends, whenever that you want to speak to a specialist, and we'll have one standing by to to help you out with all your needs. I want to thank you very much for watching this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.